On a single winter night in 49 BCE, Rome's money seemed to stop breathing. The Senate fled the city in a scramble of litters, and lamplight bankers folded their counting tables, and IOUs that had been as good as coins the day before suddenly weren't worth the wax they were stamped on. Prices fell because buyers vanished. Interest rose because fear did. And the greatest commercial hub of the ancient world discovered a modern truth that still governs our lives. Credit isn't tea metal, it's belief. Every empire swears its finances are sound. Every elite insists obligations will be honored. Yet when politics cracks, credit snaps. So here is the question that rattled Rome and never stopped returning. When everyone demands payment at once and no one can pay, who decides what a promise is really worth? Debt in the late Republic wasn't merely a private ledger of favors and fees. It was the hidden engine beneath elections, wars, and patronage, the scaffolding that held citizens, merchants, and magnates together in a web of expectation. Ambitious men borrowed to climb. Victories and governorships were supposed to pay the bill. The city's financial life pulsed through the Forum, where Argentari extended short-term liquidity from open tables, venerators specialized in longer loans, and wealthy senators recorded book credits, nomina, that passed between houses like handwritten currency. No central bank, no deposit insurance, no official backstop. What stood behind everything was reputation, land as collateral, and the courts as the final hammer. In that world, Gaius Julius Caesar rose not as a paragon of thrift, but as a product of leverage. His early career was financed at ruinous rates, famously underwritten by Marcus Crassus, the richest Roman, who traded cash for proximity to power. The arrangement wasn't a scandal, it was a business model. Office was an investment and debt was the ticket. The larger economy mirrored the elite's habits. Wholesalers advanced goods to shopkeepers on 90-day nomina. Shippers financed voyages across the wine-dark sea with transferable credits. Farmers mortgaged estates between sowing and harvest. Landlords borrowed against rents expected in the spring. 1,000 small bridges allowed people to cross from today into tomorrow. The machine worked because confidence did. Healthy, until the web trembled. When Caesar crossed the Rubicon with a legion of veterans, the news outran the soldiers and reached Rome as a rumor first, then as a run. Senators loyal to Pompey evacuated toward Brundisium to regroup. Courts suspended their sessions. Auctions were postponed. Those public tables in the Forum, the city's financial heartbeat, closed their shutters not because they lacked silver, but because they lacked clarity. Who would be in charge tomorrow? Whose decrees would bind contracts? Which judgments would be enforced? When legality itself is a moving target, even honest debt turns into a gamble. That night, Rome learned a lesson every financial center has learned since. Credit isn't about possessing coin. It's about assuming you won't need all of it at once. When fear whispers, now, everyone becomes a creditor, and no one remains a customer. The mechanics of the freeze were simple and brutal. Nomina, the book credits that circulated from house to house like a paperless money market, were suddenly discounted or rejected outright. Coins disappeared into chests, walls, and temple strongboxes as households hoarded against the unknown. The velocity of money collapsed. Without courts, collateral turned from security into a story, and lenders acted as if they had none. Acceleration notices were served where they could be, and debtors, unable to find coin, tried to dump property into a market with no bids. Estates didn't lose their farms and vineyards because vines stopped bearing. They lost the ability to translate vines into coin at any price that resembled yesterday. In normal times, credit is a bridge across time. Remove the bridge, and both sides fall into the river. Crises make politics visible. Big creditors, senators, equestrian financiers, land magnates wanted order, courts, and collection. They feared a populist jubilee that would separate them from principle as easily as wine separates from a cracked amphora. Heavily indebted elites, including Caesar's allies, wanted time and re-rating, a reset rather than a bonfire. Small debtors, shopkeepers, craftsmen, tenant farmers, wanted mercy, limits on imprisonment, fair valuations, a way out that didn't end in slavery. Merchants wanted certainty above all. Ships to sail, contracts to clear, receivables that would be treated as something more than hopeful scratches on wax. When politics polarizes, money follows. Caesar's enemies painted him as the candidate of bankruptcy and mob largesse. His supporters cast his opponents as usurers defending a rigged game. The caricatures contained truth enough to inflame each side and still dodge the question that mattered most. What happens to a promise when the regime behind it changes? When Caesar entered Rome, he did not set the ledgers on fire. He did not command a festival of cancellation or salt the counting tables with theatrical speeches. He did something subtler and, measured with the cold eyes of finance, more sophisticated. First, he guaranteed the safety of persons and property in the capital. Words are cheap, but confidence often begins with public words backed by the plausible threat of force. Second, he moved quickly to reopen the courts and restart the administrative rhythms without which credit is indistinguishable from charity. Third, he advanced a debt settlement that tried to turn panic into arithmetic. Interest already paid would count toward principal. Creditors could be paid with property valued at pre-crisis appraisals rather than at fire sale prices. Excessive interest practices were curbed. Debtors' prisons were limited. In modern language, he engineered a controlled compression of balance sheets. He did not abolish debts. He rebased them. The logic was precise. By recognizing past interest as a reduction of principal, he refused to let time vanish from the equation simply because fear had made it fashionable. By fixing valuations to a pre-crisis reference point, he blocked two nightmares at once: a creditor wipeout caused by forced liquidation into an empty bid book, and an opportunistic feast by distressed buyers, hoping to turn panic into a harvest of neighbors, vineyards, and villas. He converted property to coin at yesterday, as price long enough for tomorrow, as market to exist. He did not aim to punish a class or reward a faction. He aimed to restore the price at which strangers would meet without a sword on the table. Fairness depended on where you stood. If you were a lender confident that despair would deliver estates at 1/10 of their worth, the policy felt like theft. If you were drowning in compounding interest with no court to hear your case, it felt like a plank in dark water. If you were the city, it felt like time, purchased not with rhetoric but with rules. A city's ledger can seem abstract until you put faces on the entries. Picture the papyrus merchant on the Argoletum, who stocked inks from Alexandria and scrolls from Campania, financed on 90-day credit. The night the Senate fled, 2 wholesalers refused delivery without a court stamp. His banker, solid last week, wouldn't roll the line. Under the settlement, the interest he had already paid reduced his remaining principal. Paying with inventory valued at yesterday's price kept him solvent long enough for customers to return. He didn't prosper. He survived, and survival in a freeze is victory enough. Picture a senator who had mortgaged villas to stage grand games, purple awnings, gladiators, fountains flowing with dyed wine. The crowds cheered, the votes came, and the bills arrived. In panic, margins were called while bids disappeared. The property for debt conversion saved him from the auction block, but it also prevented him from scooping up half his district at panic prices. Stability over opportunism is a hard medicine for a patient who wanted a conquest. He swallowed it and kept his seat at a narrower table. Picture a tenant farmer's widow in Latium with 2 boys and a loan for seed that had swollen under stacked interest. Creditors eyed the sons as collateral. The law permitted what pity didn't. The curbs on harsh enforcement and the revaluation of debt kept the family on their plot. To high finance, this was a rounding error. To the family, it was everything. In the short run, the thaw worked. Markets hate uncertainty. Caesar supplied a version of certainty with legions to enforce it. Tables reopened. Nomina circulated again. Land changed hands at something like yesterday's price instead of tomorrow's despair. The city exhaled, but the underlying disease remained. A politics addicted to leverage. The Republic had normalized borrowing to buy office and looting a province to pay it back. A clever fix can break the fever. It cannot change the climate. After the knives in the theater of Pompey, debt and distributional conflict returned as chronic symptoms of a terminal condition. Decades later, under Tiberius, the credit crisis of 33 CE repeated the old rhythm so perfectly that the emperor had to inject state-backed, interest-free lending against land collateral to unfreeze the market. Different princeps, same plumbing. When trust evaporates, you have to manufacture it. Strip away the Latin and laurel wreaths and the principle comes into focus. Credit is law wearing the mask of confidence. In ordinary weather, contracts look apolitical. In crisis, they become battlegrounds. Someone must pick a price. Par, discount, or a reference point in between. Someone must decide whether yesterday S payments still count and whether today S collateral is tomorrow, S coin. Caesar's policy privileged continuity over cleansing. He understood that mass default is also mass expropriation. The difference is only whether the expropriation is executed by mobs, by markets, or by magistrates. He amputated windfalls to prevent a cascade of amputations of livelihoods. Was that interference? Of course. But a market without bids isn't a market. It's a rumor mill. History keeps rhyming in the ledgers. In 1907, a panic threatened to implode American finance. Private pools arranged by a single titan served as an improvised lender of last resort, re-rating collateral to keep solvent houses from fire sale deaths. In 2008, overnight lending evaporated and central banks swapped illiquid assets for reserves, guaranteed money funds, forced mergers at policy prices, property for debt, scaled by 2 millennia of complexity and acronyms. In 2020, a pathogen froze the world and emergency facilities bought time so commerce could breathe. Each episode summoned the same chorus of accusation. Bailout, moral hazard, let it burn. Each episode forced the same cold question. How do you keep a fire from becoming a moonless night? Save everyone and you entrench recklessness. Save no one and you enthrone ruin. save the system, and you choose winners by rule, timetable, and spreadsheet cell. The choice is never clean. It is only necessary. Confidence operates in 3 layers. The first is transactional. I believe this person will pay tomorrow. The second is institutional. I believe the courts and customs will enforce the deal. The third is regime. I believe the people with swords will not rewrite the rules. In Rome, the top layer failed first. With the regime in question, the institutions closed. With courts shuttered, transactions died overnight. Caesar's fix worked by rebooting from the top down. Assert control, restart the courts, then normalize contracts using yesterday as a temporary anchor so that tomorrow could exist. Modern policy follows the same sequence in different clothing. Stabilize the regime signal, reactivate the plumbing, then let markets rediscover prices inside a circuit breaker. It isn't elegant. It is how kitchens stay open and ships keep sailing when politics screams. The ethics of rescue are a tangle. Relief can reward vice, but collapse rewards vice too, only a different species of it, predation disguised as price discovery. There is a reason vultures and bargain hunters share a vocabulary. Caesar's settlement taxed amnesia. If a lender enjoyed last year's interest, he could not also demand today's full principal as if time had not passed. If a creditor had lent against land he secretly coveted, he could not use panic to acquire it through a loophole priced by despair. If a demagogue borrowed to purchase applause, he did not get a jubilee. He got a conversion that preserved the city around his ambitions rather than reducing it to pay his bill. Fairness is the word we use when we can afford philosophy. In panic, the operative question shrinks to something more practical. What keeps the most people above water with the least lasting distortion? And after the thaw? The Republic's fiscal physics did not improve. There was no consolidated balance sheet of the state, only a patchwork of extraordinary levies and provincial extraction whenever war demanded coin. There was no true lender of last resort. Confidence rested on personalities as much as on procedures. Elections demanded spectacle. Spectacle demanded loans. Loans demanded favors. Favors demanded provinces. Provinces demanded legions. The loop did not break with a clever policy. It broke with the republic itself. Financial stability without political stability is stagecraft. Stagecraft buys time. Sometimes time is all history has to sell. Yet the night credit froze in Rome offers more than a grim parable. It teaches what money truly is, not metal or paper, but a story about tomorrow that enough people accept today. Contracts are the grammar of that story. Courts are the dictionary. The regime is the author whose pen can, in emergencies, cross out lines and write new ones in a steadier hand. The danger isn't that rules matter. The danger is pretending they don't. When belief collapses, the question returns with a knife's simplicity. What is a promise worth now? Caesar's answer was to pin value to yesterday long enough to survive today. He didn't eliminate debt. He made it serviceable again. Listen to the way a city restarts after a freeze. The doors of the forum open at dawn and the usual quarrel resumes. Weights argued, contracts read, voices layered like doves over marble. A clerk writes a figure on wax and hands the tablet with an indifferent nod. A banker shakes his head at one rate and offers another. A merchant hurries past with a bundle of scrolls, mind already counting days and drachmas. None of them knows what the legions will do next. All of them act as if tomorrow will arrive. That is the trick, not a fraud, a decision. Confidence is the daily vote citizens cast on the future, and sometimes it needs to be shepherded through the night by someone strong enough to be boring. Caesar did not enchant markets. He quieted them. The story turns, and it darkens again. Armies march, speeches on justice mask the politics of spoils. Fortunes are made and unmade in the distance between delusion and dawn. Still, the ledger remembers. It remembers that when panic arrives, the line between debtor and creditor can blur by design rather than by accident. It remembers that law can choose continuity over cleansing, that arithmetic can be a shield, and that the question, who deserves to win, is less urgent in the dark than what keeps the city alive by morning. It remembers that there are always people waiting to profit from a fire, and people who will drown in the water used to fight it. The choice is never pure. It is only real. The parallels are not an exercise in cleverness. They are a warning against wealth dressed as wisdom. When the headlines speak of extraordinary facilities, guarantees, temporary valuation anchors, and liquidity backstops, you are hearing ancient Rome in modern uniform. When voices call to let it all burn for the sake of cleansing, remember that ash fertilizes fields but doesn't feed people in winter. When others demand that every loser be made whole and every risk be underwritten by someone else, patience, remember that generosity without memory is just a tab left open for the next panic. Between ruin and indulgence lies the narrow work of rescue. The night credit froze and Rome ended as all nights do, with morning. Ships sailed again from Ostia. Grain arrived, rents were collected. Tables clattered back into the forum's light, the steady sound of a city pretending it had not just looked over the edge. The war moved on. The illusion was not destroyed. It was maintained, and there's a cold kind of courage in that. The modern financial system did not invent the trick of turning panic into arithmetic. Rome did. The lesson is not that rescue is righteous or wrong. The lesson is that the power to set the clearing rules is the power to reallocate wealth, and that power never belongs to no one. In emergencies, it belongs to the calmest voice holding the sharpest sword. So the next time belief stutters and market seize, ask the Roman question. What is a promise worth when tomorrow's author is still being chosen? Do you fix value to yesterday long enough for trade to breathe? Do you let the night assert its logic and hope dawn will be kinder to the survivors? Every path has a price. Caesar chose a price that kept kitchens open and debts payable in something other than despair. You can debate the ethics across centuries. You cannot deny the consequence. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.